In this lesson, let's take a look at a few different indicators and how we might decide what settings we'd want to use for that indicator. So a couple of things to stress before we get started is number one, once again, there's no one indicator that's the best to use for all markets and all time frames and all types of trends. So once again, if you're already familiar with, for instance, the stochastic or the RSI or the MACD or CCI or whatever indicator, use that indicator and we'll kind of look at it logically and how we would use it with a pattern and price relationships to help identify reversals of momentum trends and cycles as well as price trends and cycles. And then the second thing to stress is there is no one set of settings for any indicator that's going to be optimal for all types of market activity, such as a strong impulsive trend or a typical correction or a trading range. No one indicator setting is going to be optimal for all those different types of market trends and corrections, and we never know what sort of trend or correction is going to unfold into the future. So we can always look at past data and say, here's the best settings that would have been perfect for that series of data at that period of time. But is that series, are those settings going to be best for the future time when we don't know what sort of market activity is going to come to us in the future? So we have to choose some settings that are useful for most types of market activity, whether it's a trend or a counter trend or a very strong impulsive trend or a mild trend, that sort of thing. So we look at different series and periods of data. We look at different settings and then say, well, this would have been pretty useful regardless of whether it's in a trend or a counter trend or an impulsive trend or a correction. So let's take a look at the data I have here. It's just gold daily data. And all three of the indicators that are at the bottom of the chart, all three are stochastics. And they're all three different settings, from relatively short look back to a relatively long look back. And of course, the shorter the look back period that you choose for any indicator, the more sensitive it's going to be to reversals of price trend and momentum cycles. So a couple of things also to emphasize before I get started is one of the primary purposes of the indicator is to help us identify the end of a correction. Why do we want to get real good at identifying the ends of a correction? Well, when a correction is complete, the trend prior to the correction should continue to a new extreme. So just like we focus a lot on pattern, on identifying the end of a correction, and on price targets for a correction, well, we're going to use that indicator to help us identify if a correction is in a position to be complete and what would be the trigger based on the indicator that it's complete and set us up for a high probability specific trade strategy. Okay, we're back to stochastic, relatively short look back, medium, and longer look back. If we just look at these indicators below this data, which we have a variety of different kind of trends and counter trends over this period of time, what seems to just stick out as be fairly obvious, I should say, follows the kind of price cycles within this series of data. So the fairly short look back looks pretty good. It doesn't oscillate between oversold and overbought all the time, but we can see clearly defined reversals, bull reversals, bear reversals. If we just look at the data, they're within a couple, 3 bars of where the price reversal was. And when it does reach the oversold or the overbought zone, that's usually in a position where it makes, let's call it a higher time frame reversal, a reversal that lasts for longer time periods. And then again, here it oscillated to overbought, fairly significant advance, back to oversold, up to overbought, and then it drops out of it and makes reversals, etc. So that looks reasonably, that could be reasonably useful. What about the little longer look back in this stochastic? Well, the longer look back flattens it out quite a bit. And it also lags the price reversals by more than just a couple of bars. So I don't think this would be real helpful to us. And it doesn't reach oversold or overbought zones until the trend is well underway, very mature, let's say. And then here's the even longer look back period. So that might have been useful just to identify let's call it the more major trends or the higher time frame trend in the market, but wouldn't have been much use for us to be positioning on the minor corrections within the trend, because it really had very few crossovers until it reached, in this case, the oversold zone, and then reversed up, and then had no crossovers before it reached the overbought zone. So we'll look at another way to help us identify a higher time frame trend using indicators, and then how we use the lower time frame indicators settings and indicator trends to position in the market. So right now we're looking at position in the market. It sure looks to me like this would be the relatively short look back would be the most useful. So what I'm going to do is I'm going to do what we call tab these. Let's make sure I have this window the maximum size. I do. So if this has been useful for this set of data, it should be useful going forward to help us identify when we might want to position in the market. And also keep in mind, we never have our trading strategy solely reliant on the indicator. We're looking at pattern and price position, and then frequently the indicator is the trigger to identify the reversal and when that trend or counter trend is complete. So let's add some more data. I'm going to just advance the data here for several weeks or months. And again, we had a strong and consistent bull trend, and then a fairly consistent bear trend as well. Well, during this bull trend, of course, the indicator hung in the overbought zone a lot because it was an impulsive bull trend. But if we look at this, each time that the indicator then dropped out of the overbought zone and made a reversal, didn't necessarily have to reach the oversold, but just dropped out of the overbought zone and then made, in this case, a bull reversal, that usually indicated the end of a correction, in this case, fairly short-term correction. So that occurred right here, was overbought, dropped out of the overbought zone, made a bull reversal. The trend continued. It was the end of a correction. Again, went into the overbought zone, hung in there for quite some time, and dropped out of it. Then it did make a bull reversal right here and just went sideways, and for the first time then flipped back around to bearish without having gotten back into the overbought zone. Trend has probably reversed. And again, strong decline, got into the oversold zone, and then made a reversal from the oversold zone, and then trended directly up into overbought. So if we were looking at this bar by bar, would we have identified from the indicator alone that this was a higher time frame low, as opposed to just a temporary low and we're going to have a 3 to 5 day correction or something? No, the indicator would not have helped us with that. It would only indicate that if it reached the oversold zone and made a bull reversal, and then particularly once it exited the oversold zone, that it had made a low of some sort, and it would really be our price and pattern position that would help us to indicate how important and what time frame low that would be. For instance, if we just look at this data real quickly, we can see it looks like a perfect 5-wave decline was made into this indicator reaching oversold and making a bull reversal. So that might have been a pretty good trigger to indicate wave 5 was complete, and then a higher time frame advance was going to occur other than just a 3 to 5 day correction, which is exactly what happened. So once again, as we continue through this course, we'll see how we actually use the indicator to help trigger us at least into trades, as well as identify the probable position of the market, whether it's at or near the end of a correction or at or near the end of an impulse trend, that sort of thing. But right now we can see this indicator, the stochastic, could have been very helpful in this market. And the stochastic indicator is very popular with traders. And it's just a matter of the settings and what settings help you to identify when a market has completed a correction, when it gets into an overbought and oversold zone, particularly with the stochastic. It's usually indicating that that's the trend of the market. That's the higher time frame trend. And we want to look at any time it dips out of that extreme, overbought or oversold, and then makes a reversal, and what is the follow-through and not the follow-through. So how did I arrive at these particular settings? Once again, I just brought up the menu for the settings for the stochastic, and I just adjusted them up and down a bit, such as that. We can see until it looks like they've pretty much cycled with the price cycles and dropped in and out of overbought and oversold zones. So you can play around with those, and that's all that I did. And also, I wanted the settings so the reversals were fairly clear. The crossovers is what I mean by the reversals. And most charting programs, see, that's all I did. Just moved them up and down until I got where I could see the cycles. Most charting programs, then you can set alerts for when they make a crossover. And that's what I do, is I set alerts on the program and on the particular chart so that it alerts me whenever an indicator makes a crossover on any chart that I have and for any time frame. Well, this is also daily gold data, and the indicators below the chart, these are all RSI indicators. And again, I've got 3 different look-back periods and 3 different smoothing periods to show on the chart. They all look kind of similar, don't they? It's very much like the stochastic. And in fact, these 2 indicators are relatively similar, but they're the 2 most popular indicators that traders use. And if I look at these different look-back periods, similar to the stochastic, the longer look-back, this is the 21, it doesn't seem to make the kind of signals quite as well defined at least, as the shorter look-backs. So I would be focusing on either this 8 look-back or the 13 look-back. And between the 2, there's not a lot of difference. They both tend to cycle from overbought to oversold. And by the way, notice these overbought and oversold lines. I think in the stochastic, it's more typically around 70-30. With the RSI, it's more typically around 60-40. And again, there's whole courses out on RSI and using different configurations of it, different settings. But we just want it to help us get an understanding. If a market is near an extreme, then what is it? Indicate a reversal signal that reversal has been made in price as well at the end of a trend or the end of a correction. And very similar to the stochastic, let me just go ahead and untab these so we can be looking at just the one RSI here. If it's in the overbought zone, and then if a market comes down out of that overbought and makes its reversals, its bear reversals here, if we had some indication that the trend had reversed to bear, it'd be great setups on the short side. Again, pops into the oversold zone, out of it, makes a bear reversal, again, and then the market continues lower. Now here it made a bull reversal. The indicator itself would not indicate that the higher time frame trend is reversed. Most indicators, they don't do that. But if we had, for instance, well, this is another one, looks like we might have finished a 5-wave decline here, or something along that order. If that's the case, and we're looking for a reversal in the higher time frame trend and reverse to bullish, then we'd look for our indicator to help us identify the end of corrections. For instance, here it was oversold, and if we have some indication that the higher time frame trend had reversed, this would be a great setup to have identified that a minor correction was probably complete. Popped into the overbought zone, helps us to identify that the higher time frame trend is bullish, came out of it, and then made a bull reversal to continue the bull trend. Back into the overbought zone, and then kind of sideways, and then down and down. The fast line just touched the oversold zone and then made the bull reversal, indicating that potentially this correction was over. And then, again, the indicator went and hung into the overbought zone, typical of a bullish trend. Made a reversal, and this is called a double reversal, and this is on a slight bearish divergence. A lot of these indicators are used to identify relative strength and weakness of bullish and bearish divergences. Then when it declined out of the overbought zone, more than likely the higher time frame trend reversed. Okay, so they both, RSI and stochastic, are similar indicators, and we'll see how when we look at them in the perspective of the time and price position, they can be quite valuable to trigger us into trades or to adjust our stops. Let's look at one more indicator. So this is the similar data that we were looking at. So this indicator is the DT oscillator, the dynamic trader oscillator, and it's a momentum indicator that's in my program Dynamic Trader. And it's similar to these other indicators. The major difference here is it does tend, if you get the settings right at least, to oscillate from overbought to oversold a little more clearly than it does with the stochastic or the RSI. So I really focus on using this indicator, but we'll take a look at both this one and RSI and stochastic as we go through the course. But it does a pretty good job, particularly of identifying the end of corrections and then making it a bullish reversal, in this case from the oversold zone during this higher time frame bullish trend. But just like all the other momentum indicators, if it's a strong impulsive trend, it hangs for a while. A lot of times it'll oscillate in the overbought zone, and a strong bull trend are in the oversold zone and a strong impulsive bear trend. So that's the weakness of all momentum indicators. So we just have to live with that. We have to choose what is the best settings that are going to be helpful for us most of the time. And similar to when we looked at the stochastic and the RSI, the relatively short settings pretty much identify pretty well, at least, the fairly short-term cycles of these corrections, and it would be very helpful for us on its bullish reversals and the bearish reversals for a bear trend to enter at the end of a correction. Again, we don't make a decision based solely on the indicator, but we'll see how we use that information with our price and pattern information as well. So that said, you can see how you can put one indicator up, put several different settings, and just see which one do you think would be the most helpful given different sort of trend and counter trend corrections, trading ranges, that sort of thing, different sort of market conditions. And don't try to over-optimize. Just do the settings so that, particularly if it's around corrections, it typically gets a bull reversal or a bear reversal if it's in a bear trend. But we really wanted to focus on it helping us identify the end of corrections, because as you can see with all these indicators, if it's a strong trend, an impulsive trend, getting into the overbought zone, in this case in a bull trend, is not an immediate indication that we're making any significant high, because the impulsive trend can continue for some time. We really want to use it to help identify the end of corrections. Okay, let's continue to the next chapter and see how we integrate the momentum indicator position with the price and pattern position for specific trade strategies.